that might affect an individual bank, but also the whole financial system. So it is a systemic risk. And we believe, if we believe that lending to green projects, to renewable energy, is more safe from a systemic risk point of view, we should maybe reduce capital weights. So there are two things. Brown assets maybe have an extra charge and have a discount on green investments. This could be done in the same way as we have now the SME support factor. It is totally something different. I realize that it's a much bigger sector. It's from a different perspective. It's more from a risk perspective, where the SME supporting factor has another background. But I do believe that mechanism can be used also to put an extra charge for brown assets and a discount on green assets. It's a sensitive discussion, but I believe we should have that discussion. And I think also the banks will start to work with it if it's clear what way forward have been chosen there. To put it simply, we have to differentiate between the risk weighting between fossils and renewables. That's what I'm hoping for. So that are two very concrete proposals I would like to discuss more in depth with you, and particularly with the high-level expert group. And I hope they pay their attention to these aspects as well, because although I believe that more awareness and more transparency, as they propose, is very important, it's not enough. We should go to the hard matter and really look at this sort of measures as well. So thank you very much for your attention, and I hope we have a fruitful discussion.
Thank you. Next up, we have Catherine Howarth from Sphere Action.
Good afternoon, everyone. Very nice to be here. Extremely pleased to be invited to speak at this Bruegel event. Just really briefly, Share Action is an organisation about 12 years old, which has, for a number of years, championed being the voice of the interests of the ordinary saver. Initially in the UK, where we were, where our origins are as an organisation, but increasingly right across Europe. And so we're major sort of champions of sustainable finance. And part of the sort of work that we do, for example, is ranking the responsible and sustainable investment performance of the largest asset managers in the European area. But we've been focused for many, many years on this question of, do we have a fit-for-purpose definition in practice in the investment system of fiduciary duty? So we're absolutely thrilled that the high-level expert group has focused on fiduciary duty as a key piece that, in their view, and we share that view, can help unlock the behaviours in the investment system and amongst and between the complex range of intermediaries that occupy that investment system. If we can get a common and reimagined, reinvigorated conception of fiduciary duty, that will, in our view, help to unlock the sustainable behaviours that we absolutely need from the financial system if we are to meet the goals of the Paris Agreement. So I'm going to spend a few minutes, first of all, outlining what we're talking about when we describe a kind of reimagined conception of fiduciary duty, why we think that's such a smart focus for the Commission as it develops its journey and its plans around sustainable finance. And then thirdly, kind of some of the practicalities of how we proceed and make some headway in the context of the complex range of directives governing financial institutions in the Union. So just first of all on the kind of the conception. So there's, as many people will be aware, there's a kind of common law tradition, there's a civil law tradition, there's lots of different things that have led over the years to an evolving conception of fiduciary duty. But I don't want you to get too bogged down in it, because in a sense, the core here is to achieve a carefully conceived yet appropriately flexible code of conduct and set of duties falling on financial institutions who are responsible for looking after somebody else's money. This is about saying, if you are looking after retail investment funds or my pension scheme or my assets, how do you conceive of looking after my best interests? Because if I give you my money, I expect you to be on my side and looking after my interests. And what we've seen over the years is a dangerous narrowing of what that means, so that it's interpreted simply as, well, my job, and I'm doing my job as an institutional investor, if I maximise profits in the shortest possible timescale, probably against a benchmark, then I've done my bit. The problem we have is that that conception of fiduciary duty is actually a great danger, or has been proved to be quite a danger, to the individual who puts their money in the system and hopes in good faith that the people who are paid, often very handsomely, to look after that money on their behalf are doing their very best for that end saver. So the core of this is about protecting the best interests of the beneficiary or the end investor. And the issue is that we've gone rather astray in terms of how people in the system have understood that. And I think that's given rise, indeed, I would argue, to, the entire financial crisis was predicated in many ways on a misunderstanding of what really looking after someone's best interest was all about. So instead, we need an interpretation of fiduciary duty which gives appropriate consideration to the influence of climate change, social performance of companies, the governance and quality of governance of boards. All of these things will lead to me, as a saver, probably ending up with a bigger pot of money when I come to retire and draw down that money. So at one level, and this is very well expressed in the High-Leg report, we need an interpretation of fiduciary duty which takes appropriate account of the many environmental, social and governance issues that will affect the financial performance of my investments. But actually it goes a bit beyond that as well. Let me express how, I'm just going to put it in terms of me, myself, but hopefully you can relate to this. So if you've put your money into a pension scheme or an investment fund, and the fund manager running it thinks, oh, this company, I really like this company because it's got a very aggressive tax avoidance strategy, which means we'll probably make more money on this investment. As a citizen who entrusted that fund manager with the money, it's not in my best interest because I might end up paying more tax as a result or have lower public services or lower quality of services. What I want is a fund manager who can grapple, and it's not easy. I'm the first to say that this is moving to a more sophisticated version of what acting financially on behalf of someone else looks like, but that will say, actually, in acting on behalf of Catherine, or you, I am going to encourage that company to behave in a pro-social way, not to pollute emit more carbon than necessary, not to avoid paying its full due of taxes in the different jurisdictions it's a part of. And indeed, I'd really like to have a fund manager that's engaged with and has had a conversation with me about my ethical interests as well. So, I may be very passionately interested in not being invested in companies that have a supply chain full of modern slavery issues, or which have taken absolutely no heed of animal welfare in their operations, or whatever it may be. So we're getting to a world where we have a more sophisticated, admittedly more complex, but ultimately much more satisfying conception of what acting in my best interest or your best interest looks like. So, and related to that, I think we need an understanding of fiduciary duty in which I, as the end investor whose money is at stake, have real visibility on where my assets have been invested, how, for example, shareholder rights in the companies in the portfolio have been exercised on my behalf. I might want the right to be able to contribute and feed into the development of investment policies that are made for the fund concerned. I might want the chance, for example, to attend an annual meeting of the people in the fund or in my pension scheme so that I can actually meet face to face with the fiduciaries who act on my behalf. I can ask them questions, I can hear from them an account of what they've done to protect my best interests. I might even, and this is probably more common in the context of pension schemes and other type of investment vehicles, want the opportunity to stand for election to be on the board of that organisation. And for other fellow members of that scheme to be able to vote me in or vote me out, and similarly the other members of that board. I certainly want a fund that gives an account each year of the actions it's taken, both financially and non-financially, to meet my best interests. So, what we're grasping towards here, and the high-level expert group has put on the table in a very bold and important way, is the need for a common conception that can evolve over time and has got enough flexibility built into it, but will lead to a European investment sector that is focused on the real people they serve in the real economy that we belong to, and thinks about their financial interests as a long-term endeavour. And my goodness me, as a pension saver, and this would be true for many of us in many different countries, I'm genuinely very concerned I may not have enough to live on in my old age. I very much do need the excellent financial performance out of these institutions. It's not about sacrificing the excellent financial performance in order to bring into focus these other non-financial considerations. It's about having a sophisticated and nuanced balance where the people that act on my behalf in the investment system think about my financial interests and my quality of life and the society I'm a part of, and then that becomes part of how we conceive excellent investment in the European Union. And I think if we can build that into the vision of the Capital Markets Union that's under development, we're going to end up with the most, or enhancing the existing excellence of the European investment industry, and crucially building social trust in the system that we're a part of. So then, just to move quickly onto the practicalities of this, we've obviously got a panoply of existing and very important bits of legislation, whether it's MiFID II or PRIPS or IOPS II or UCITS or Solvency II. And onto those, we need to lock on this more broad and nuanced conception of fiduciary duty. We absolutely need, in the context of sustainable finance and the ambitions to achieve it, regulatory certainty, a level playing field, and a world in which European savers should have the same protections and rights wherever they are in the European Union. And the certainty that wherever they invest, whether it's cross-border or in their own country, the individuals who invest on their behalf are accountable to this more nuanced and broad-ranging conception of acting in their best interest. So I think we're with the high-level report, we're moving in that direction. It's extremely exciting and encouraging, and we look forward, Share Action, but with many others in the room, to developing that more sophisticated conception of fiduciary duty and then finding ways to lock it in a practical way for the benefit of savers across the European area.
Thank you very much. We now have Stuart James from HSBC. No. Best to get.
It's also recorded. So.
There we go. Thank you. So the lectern fooled me. But, well, it's a pleasure to be with you all. I think the high-level task force has done some fantastic work, and it provides us with a real opportunity to move the agenda forward, and in particular for Europe to lead in doing that. I wanted to really build and complement what previous speakers have said, and if you like, the theme that cuts through what I've got to say is the need for public and private cooperation in trying to achieve what is a mammoth task in the shift to the low carbon economy. And three things that I want to touch on. The first is disclosure. The second is the need for public-private risk sharing. And then I want to talk about the complementarity of the prudential capital framework, as Peter also touched on, but with a slightly nuanced view from the one that you gave. So first, disclosure. I mean, for my money, this is the key public policy step forward that we're hopefully able to take this year. We've just carried out a survey of the investment community, and it's very encouraging in terms of just where the market itself is placed and where it's trying to go. The results of that survey, particularly for Europe, showed us that 90% of investment managers wish to and intend to take account of sustainability in the investments that they make. Unfortunately, it also showed that only around 50% believe they have the necessary information on which to make the required judgments to know that they're making sound investments along the lines that we've just heard from Catherine. So the market, though, I think, it leaves me with the impression that the market is sort of poised to move in the right direction. And that's why I think that this disclosure piece, and in particular the work of the Bloomberg Task Force, is a very key piece of the jigsaw that's going to actually allow it to start shifting. Now, if, like me, you've followed with some enthusiasm the work on disclosure, I was very buoyed with the political backing that it got from the G20 to begin with. And it is, after all, something that came out of the public sector from the FSB and Mark Carney's work. Slightly disappointed that, given the political changes and difficulties around the Leaders' Summit this year, that it had sort of drifted a little bit purely into the private sector to get on and implement. And I think we really need to try and keep political momentum behind this work. But nevertheless, glass half full, we now have a set of recommendations which I think, if the industry, and not just the finance industry, but all core industrial sectors that are particularly relevant when we think about sustainability, if they go ahead and implement these recommendations, they will begin to actually move the money that's out there looking for sustainable investments into the kind of investments that we want. The key things for me, and I'd be interested to hear views, that implementation needs to be global. It needs, if you like, to include all the key industries that I've said, and it needs to have some sort of public sector backing. The regulators, etc., need to be encouraging their industries to go down that route, and for the industry to feel that there would be some sort of penalty for not going down that route. Otherwise, you're going to get free riders. People will move in that direction, but there will be a whole load of people who will stand on the sidelines and take advantage of the fact that they're not having to do that, and it really won't work. So ultimately, I would like to see, in common with most people probably, a mandatory approach to this. But we've got to learn by doing a little bit first. We're not in the right place yet to be able to have all the metrics that capture the extent to which a firm's strategy is in line with a low-carbon growth path, for example. That will take a little bit of time. So I think a voluntary approach to implement disclosure is probably the right one for now. But it needs to have pressure, I think, from the public sector. And here I come to Europe's chance to lead. While I don't think detailed rules would be appropriate at the moment, I could imagine enabling legislation, something that gives an umbrella framework within which the relevant industries get on and implement, with always the sort of sword above their heads, should they not do so, that legislation will follow as a really good way forward. So Europe, I think, there has the real chance to lead and put us in a great situation. So the second theme I have is the need for greater public-private risk sharing. The OECD tell us that the infrastructure gap, most of which we would of course wish to be sustainable, is at around 100 trillion over the next 15 years. Huge sums of money. Can't be done in the public balance sheet alone. Can't be done in banks' balance sheets alone. You need to move all the potential assets for saving that are out there. One of the difficulties we have, I think, in meeting that infrastructure gap is that the private sector finds it difficult to take certain types of risk. And this can be around political risk in emerging markets, the stability of the legal regime, your right to recompense if things goes wrong, issues around that. And I'm very encouraged at the work of the multilateral development banks at beginning to standardize and put much more effort into the way in which they can come alongside the private sector and crowd in private finance by working together on infrastructure projects in particular to try and plug this gap and move things forward. It's a key issue because for the last 4 or 5 years, we've sort of danced around it. Everyone talks about the gap, everyone talks about the wall of money that's waiting to invest in it, but it never quite happens. And I think this risk sharing, which we're becoming more forensic at and better at, but we still got room to go, is a real key. That needs to happen at the sort of individual project level, but it also needs to happen at the market level. I know that securitization is a bad word, but if you can pool the assets involved in individual infrastructure projects and commoditize them, if you like, you will bring in a different class of investor that at the moment sits on the sidelines but would in principle like to get involved in these sustainable investments. And provided it's done right in terms of the quality of the assets and ensuring that and having metrics around that, then I think it could make a huge difference. So that's the second thing that I think has the real potential to move us forward in this environment. The third thing, this prudential framework. I agree, and I think we all agree, that it would be great if the prudential framework could incentivize sustainable over non-sustainable investments. The problem, I think, is less banks, Peter, and their desire to move in this direction, and more the desire of prudential regulators who don't really like their prudential framework being used to achieve other public policy objectives. But if we really believe in COP21, and we believe that governments will take the necessary policy decisions to make that a reality, then it seems to me axiomatic that sustainable investments will become more creditworthy and less risky than non-sustainable investments. So if you believe that, then it's key that a risk-based prudential framework should eventually incentivize the investments that we want to see. The problem is getting from here to there. And I think in the first place, without going into the detail of the capital framework, individual regulators do have the ability to make, if you like, sort of subjective judgments along with the banks that they regulate about how well they are transitioning to this low carbon future, and to reward them in some sense if they are showing a great awareness of the sustainability challenge and reducing their exposure and moving in line with their investments to a low carbon future. And they can do that, and we're beginning to see the more sort of progressive regulators move in that direction through the sort of Pillar 2 approach. But we also need to make sure that eventually Basel I, the kind of hardwired rules, actually reward banks for making this kind of investment over, as you say, fossil fuels and traditional investments. And even though the data is probably not there to justify that in the eyes of prudential regulators at the moment, it certainly will be if we believe that the policy environment is going to change. So recognizing that, talking about that, putting again a sort of enabling environment and anticipating it in the Basel I rules seems to be something that we should call for and do right now. And I hope that, again, Europe can lead in that regard. Thanks.
Thank you very much. Now we have the last speaker. Dirk, you want to speak from here? Oh, okay. Dirk Schoonmaker from Bruegel.
new sharing economy. So first of all, I'm happy to see so many of you here at this Bruegel event, and we're very happy to be active on this topic. And what I would like to do today is to introduce very shortly a new essay on this topic. I'm trying to get the next slide, but yeah, there it is. So it just came out before the summer. An essay on investing for the common good and a sustainable finance framework, and I would like to pick 3 items out of it: change in mindset, short and long term, and finally also to make some concrete proposals, because in the end we have to stop discussing and to do something. At least my wife is telling me that sometimes to me. We need to do things to make it happen. Yeah, the next slide. I think it has already been said by all speakers before, so I can be very brief. The basic thing what we have to do, because hopefully not all of you, but most of us, we are hindered by our finance and economics training because we think it is only about economy. But those of you who are not economists know that there is more in life, and that we have to incorporate the social and environmental challenges, of course, as well. And the wedding cake is starting from the bottom. That is more important than the things on top of it. So we really have to pay attention to it. That's the underlying idea, the F, the S, and the E. And then the question is how to rank them. That's on this slide. And there I would argue it is a change of mindset, because the current thinking is the only thing which is important in town is the financial value, and that's what we call the shareholder value, and that's the most important, what we should take care of. And the other speakers have clearly, Catherine and Peter have clearly highlighted that is not sufficient. The next step is that we say, okay, we really think that not only financial but also the social and environmental externalities of values are also important. That's what we call the stakeholder approach, and I'm from the Netherlands, as one of the Rhineland countries, where we have the stakeholder model. So not only the shareholder, he's also part of the game, but also clients, employees, society, and the wider society count. And you try to balance the interests, and you move also to the medium term. One step further even would be that you take the societal interest, the common good, up front, and then only check afterwards whether the financial viability of the project is okay. But already moving from the shareholder to the stakeholder value would make a big step, and it would make a different way of looking at investments. And I think it is extremely important that to make progress, we first need to rewire our thinking, so changing our mindset. Once you think in this new framework, then the solutions as proposed by the previous speakers become easier, because then you recognize that the social and environmental issues, even if they don't have a financial value attached to them, can sometimes be equally important to pursue. Then the key issue is we are at the short term, including at the slides. And the short term is really market driven. And my profession, my other job is finance professor, is part of the problem, because we are teaching our students that the best thing to do is to invest in the benchmark, and that you are okay if you are doing equal to the benchmark or do better. If you are below the benchmark, the FTSE 500 or whatever, your favorite, then you have done poorly as asset manager. The result is that every investment manager starts to invest in all companies, because then you track the benchmark. And you have in every company a small stake, so your influence as investor on company strategy is very weak. A good example is the Norwegian pension fund, the biggest one in the world, 800, 900 billion. Still, because the Ministry of Finance in Norway tells them to follow the benchmark, or that's how they measure them, they have about 1.5% in each company. So they don't really use their market power as investor for changing things. Well, on paper, they are very keen to be a responsible investor, but this market orientation is hindering them. So what's needed, especially pension insurance money, is long-term money, is patient in theory. And the challenge is how to get there and how to align, engage with the companies and allow the companies to go for long-term value creation. And there I come to my final slide and to the concrete proposals. Yeah. So we need long-term commitment rather than taking a passive stake of 1% or less. Really long-term commitment. And it means on the side of the professional institutional investors that we should reward them. After all, I'm an economist. You reward them for staying with the company, and one way of doing that is if you stay for 3, 5 or 10 years with the company, then you get extra loyalty shares compared to the shareholders who don't stick with the company. So you reward investors to stay with the company. And in that way, pension funds and other long-term investors can show a long-term commitment to companies. And then if you're a long-term investor, then automatically you will engage with the companies on the right strategy towards including ESG factors. So that's number one. And as said before, and Peter already introduced it, we should also empower the citizens, the consumers, by giving them access to sustainable retail funds. Nowadays, the current vehicle for the insiders is usage, and the important element in usage is the T for you can transfer the securities, so you can sell them on the market whenever you want to get rid of it. So that is no commitment. And then to replace the T by an S by sustainable. So you can invest in sustainable funds, and in that way, also the retail investor can help out on infrastructure, on other elements, on this long-term investment projects which have a social and environmental component. And in this way, both the professional and the retail investor can be part of the solution, because in the end, finance is about the real economy, financing the real economy. And in this way, we can go back to the real economy and try to forget about minute by minute following of the market benchmark. Thank you.
Thank you very much. We can now move to your questions. I'll abuse my position of power and start just a bit with a general question. I mean, you've all talked about what needs to be done, and part of it is regulatory, be it, changing Pillar 1, Pillar 2 requirements maybe, or changing things at the Basel level, or changing things from the code of conduct point of view. And part of it needs to be a more sort of an effort to engage private and public bodies to make a shift in this. But I was just wondering if you could each just give me one challenge which you think is the biggest challenge in achieving the shift, and how it could be tackled maybe. I don't know who'd like to start. Anyone?
The biggest challenge.
Yeah, I mean to making this shift successfully.
Well, I think the main challenge is, interesting enough, not so much how we look at financing green, but how we can move away from brown. So 1% is in green, 99% is in brown. So we can focus very strongly on the 1% green and make that 2%. But for me, it's interesting, and now from a broader societal point of view, how do we make rules that we accelerate in moving away from brown? And in a responsible way, so there is a transition period needed, but just by having a carrot for green and not a stick for brown, I think we go too slow. That would be, for me, the main issue, because I realize it will have quite an effect on banks, on the real economy. But I think the effect of not doing enough is also quite dramatic. So that's, for me, the main issue.
Thank you. Catherine?
Two things. One, which is already mentioned, which is we do have a kind of tyranny of high carbon benchmarks at the moment. Can people hear me? So for a lot of funds, especially in pensions, but beyond as well, you know, that the cheap and easy thing is a passive exposure to what is effectively a very high carbon benchmark. And so you just lock in everyone into this status quo position. And that's, there are huge advantages of passive investing. It's cheap, and you know, active asset management has repeatedly come up short when it comes to value for money for the customer. So there's this tussle between achieving value for money and challenging active management. It's not worth it. But on the other hand, throwing yourself fully into passive benchmarks where you are basically rewarding incumbents in the high carbon industries that have huge market caps, that's a major sort of hindrance, and we haven't really worked out quite how we get out of that one. And if I may make one other point, which is separate but probably related, they all collect together really, which is there's been a huge focus on remuneration in the corporate sector, very little focus on remuneration and incentives further up the chain in the layers of intermediaries inside the capital markets, particularly sort of equities fund managers. I mean, if you find, and this is incredibly untransparent, either to the pension saver or the retail investor, that your fund manager is basically going to get a huge bonus if he or she, usually he, but occasionally she, outperforms the index over a 1 year time horizon, then inevitably those people are incentivized to focus on that. And so we actually need a careful scrutiny of whether agents in the system are being rewarded for behaviours which align with the underlying long-term interests of the real end investors. So those are a couple of issues that are pretty tricky, but we have to crack them, otherwise we're not going to get through to the golden heights of a truly sustainable financial system.
Great, thank you. You good? Stuart?
Yeah, key to the sunlit uplands for me is, I would say, when the cost of capital for sustainable investments is lower than the cost of capital for the others. And for me, that means developing a language of green that works throughout our markets in the way that we have a language on credit that everybody sort of understands and is established and works now. So, we understand, I know credit rating agencies have their flaws. We all saw that, and they have their critics. But generally speaking, the concept of having a language that all market participants understand on the creditworthiness of potential investments is clear, and we need to develop that from a sustainability index point of view.
Thank you.
I think the biggest challenge is that if you cannot measure things, then they don't count. So the financial value we put on the balance sheet, either cash or manufactured capital, but natural capital and social capital, human capital, we don't put on the balance sheet of a company. So that's why we don't put a return on it, so that's why it doesn't count. So the integrated reporting, and I think the Bloomberg Task Force is a first step with the carbon emissions, but to get integrated reporting, so we put the natural and the social and the intellectual and human capital in addition to the financial and the manufactured capital on the balance sheet of the companies, and then start to think in returns, not necessarily only in currency, but also in general. Then we can make progress in looking beyond financial values and incorporating social and environmental issues. So we should start measuring them and including them in our balance sheets and in our thinking.
Great, thank you. Would someone from the audience like to have a question? Here we go.
would like to, Francesco Abbadia from Bruegel, I would like to follow up on the last point of Dirk. Is it conceptually possible to measure F and S with the same precision with which we measure F? I mean, the benchmark at the end of the year, you know very well what it returned. And you did better or you did worse, that's clear. But is it, I understand that we would wish to measure other things than financial return, but is it conceptually possible to do that?
Should we answer this one or take a few more? You can take a few. Okay, let's take, there's one at the front over here.
Thanks a lot. I'm Giorgio Clarotti. I'm working in the Commission when I am the man drafting the work program for investing in health research. So that's a team effort, which finished just Friday. We're investing 2.2 billion euros in health research. Now, the Commission is practicing what it has said. Since the SDGs were adopted, every major investment is tracked so that we have to link to the SDG. So when you speak about the indicators, we have guidelines inside the Commission which say, is this investment on this medical research technology going to benefit the environment or going to mitigate the impact of climate? We're not amongst those who change it. So I think it was a huge effort which was really led by President Juncker. We're doing it. Over a 2.2 billion euro investment. So I wonder why companies, which I think are better managed than the Commission when it means tracking and all these kinds of things, it's not been enormous to add that, I would say. And we're reporting on it, and if we don't stick to it, our colleagues in DG Klima and DG Environment are just going to say, not good enough. You need to hit 35% of your investment impacting on climate. You need to hit 60% of your investment tracking environment.
I fully agree with you. What we have done in our annual report as a bank, take all the 17 SDGs and measure the bank's results against that. Now, the SDGs are not so precise as the number of 70 indicates, so work has to be done. And I know some of the banks in the Netherlands are working on it now. It starts with the level of the bank, and I think that's the right level to start, see how as a company you perform. But I envisage that step by step, the SDGs become, or maybe a couple of SDGs, part of the credit decision. We do that already for 37 years. We first ask the question, how does it contribute to society? It's a way of expressing SDGs, but SDGs really provide you a more detailed way of looking what is the contribution to society in an integral way. So economics is there as well, and finance there as well. And then you start to look, is it bankable, yes or no? Now that order of things I think is quite important for banks if they want to be more aligned with society. If not, it becomes still an abstract calculation and there is not this real alignment. So things are happening, but too slow, I would say, and we can make more progress there. So I thank you for
Let's just take one more at the back. There was one, I think, or here anyway, and then we'll answer and go for a second round. Yeah, I think the one at the back was before.
Hi, Sebastian Godino with WWF. Two questions. The first one is on reporting, which is obviously a big issue. The Bloomberg Task Force, the TCFD, made recommendations that explicitly apply to financial institutions as well. So would you support that also for financial institutions it should be voluntary first, mandatory then? And for your own financial institutions, would you potentially commit to have a TCFD-aligned reporting as from next year? And the second question is on benchmarks. There is now increasingly methodologies available to assess the climate alignment of different benchmarks. For example, it's possible to say if FTSE 500 is 2 degree or 4 degree or 5 degree aligned. It's certainly not 2 degree aligned. And do you think it would help to have climate disclosure on the benchmarks, to require the the index providers to disclose how the benchmarks are aligned with the climate scenarios? Thank you.
Thank you. Yeah, well, let's answer this one and then we'll go in a second round. I think Dirk, you're the main.
Can we measure the S and the E. What's happening is there are more and more data available. That's called Sustainalytics. And for example, they take a carbon price for $50 to $100. So more and more items get a market price. For example, social conditions, you can calculate a living wage, which is country dependent. So you can calculate these items, and then in that way, you can start the measuring. And unfortunately, I took accounting as my second degree, and nothing is really absolute. So even the value of your house depends on what's happening in the neighborhood next day. So valuation is always subjective. That's life. And also in S&E a bit more today than financial values, but the amount of information what is getting there on these issues enables people to make a full and integrated report with the other capitals. And some companies, like Philips, who's big in healthcare, are starting to do it, to putting these capitals also in their annual report. It is still less precise, but I think that's only a question of degree, and time will help there.
Peter, do you want to add something?
Yeah, I just want to say that I feel the social dimension is very hard to measure in our experience, because we live in a diverse society. So what is social in one country is maybe not so social in another country. I remember that in SRI ratings, allowing unions to be part of a company was quite a positive thing in the US, where in Europe it was obvious that you would allow unions. So it's not so easy on that level to compare things. I do feel, and we do an initiative in the Netherlands with the banks, most of the banks, where we want to really make clear what the CO2, the carbon impact of the portfolio of the bank is. Because banks did already for their own processes, but the most important thing is your loan portfolio. And then start to really measure the integral impact, CO2 impact of your portfolio, and start to compare. I think if we have that number right, and it's not easy, even CO2 is an exact number, it's not easy, then I think you really make a step and see how portfolios are performing from a carbon perspective. And that will hopefully bring us in the next step that certain things are more advantage for a bank to do and others are not. And then we come back to the capital weightings and so forth and so on. Because if there is not a stick or a carrot in the end, probably nothing will happen. Then it's nice, transparent, but some of the customers will appreciate it, but 90% will just take it for granted.
Is there anything you wanted to add on benchmarks?
Well, I should answer the direct question to the banks here, will we implement? So on the TCFD, yes, fully behind the recommendations. In fact, while I think there's good arguments for starting off voluntary, further than that, I think we should be clear that the ultimate destination should be mandatory and global, and that's what we want. As for will we do it next year, we will certainly have started by next year. I think there's probably a lot of technical things that I'm not maybe even privy to myself in terms of what full implementation means. I don't think anybody will implement fully by next year because there's an awful lot of metrics to be worked out and data to be gathered, so it will inevitably be a journey, I think, over a couple of years as data quality improves. And I think it's important to realise for a bank, we can make this commitment, but actually the quality of our disclosure depends ultimately on the quality of the disclosure of our clients, because only when we know how sustainable or not our larger clients are can we truthfully declare to the market, and also that allows us then to set direction on reducing our own exposure. And not surprisingly, we're not particularly in the business of throwing clients out of the balloon, as it were, if we can avoid it. So really, this is a journey. Yeah, but really, it's a key point. It's a journey that ideally we would like to make with our large clients, so that we tell them the direction we're going in reducing our exposure, and encourage them to come more into line with a sustainable future. Although ultimately, if they don't, then we have to, we have to take the consequences of that and still reduce our exposure.
Catherine.
Or just to respond to that, because it is fantastic to have HSBC Bank publicly committing to not just to implementation itself, but to the benefits of a mandatory approach, which I think inevitably at some point are going to be necessary. And I am sympathetic with the idea that we need a few years of testing and people kind of figuring out what are the different approaches to implementing these. And there's been quite a lot of discussion in respect of TCFD around scenario planning as one of the kind of important innovations inside of that framework. But I think the other thing that's really important in that framework is that it proposes corporate disclosures, but also investor disclosures, both asset managers and asset owners. And so it's a whole chain. And I have to say that it's quite interesting because institutional investors quite like disclosures by their investee companies, but actually when the boot's on the other foot and have to do their own disclosures, they're scratching their head and thinking. And to be fair, the same point applies, which is that it is their disclosures will be based on data from their underlying entities that are in their portfolios, and they are a bit stuck guesstimating until real data is forthcoming from those companies. But nevertheless, it is so important that the institutional investment community is held accountable because it's investing on behalf of millions of people who need these risks managed in a sophisticated way, and those risks currently are not managed in a sophisticated way, but we need to get there. And that will both protect people's retirement savings and lead us to a low-carbon economy at the pace required.
We'll take a few more.
Very interesting discussion, Sandrine Dixon de Clèves. I've been working in the area of sustainability and climate for the last 25 years. The banks have gotten involved pretty much over the last 10 years. So this conversation is ripe, but it's taken a long time. So I have two questions. We're talking about corporate purpose, which is on a high. We've got now our Paris climate goals. We have our Mission 2020 goals, which are actually around the corner, which is 2020. How long is this really going to take to be real? Having worked with the World Bank and the IEA and also one of the UN agencies on energy, we started to look at real in terms of producing heat maps. So we decided that there would be some areas that unfortunately would fall off the map because the impact geographically wouldn't be as huge as if we brought energy efficiency or renewables or other low carbon solutions to particular countries or geographies. Is there a heat map for the finance sector? Are there areas where we absolutely need to transform now so that we can have an impact by 2020 and 2030? And are there other areas where, yes, long-term investment is fine, but is not going to really get us to where we need to go in 2020 or 2030 if we're going to have clear transformation? Thank you.
Just maybe the lady next.
I'm Mirjam van der Stichler. I'm a senior researcher at SOMO and member of the high-level expert group. The major challenge that I hear is the costs of really looking at what the impact is. I mean, the benchmark area is a matter of it's cheaper to follow the benchmark, and you were talking about credit rating agencies. It's easier to ask your credit rating agent who has probably done for others. But it seems to me that the banks, such as Toyota's, were really trying to see what the impact is, but it costs money. And it seems to me, I don't see how the externality that has been happening now is going to be integrated, and who's willing to have the cost to really look at whether or not you have an impact. I'm actually asking a question very precisely to HSBC, because I've been looking at the financing of the palm oil companies. HSBC is big in palm oil companies, which really we know very clearly from all kinds of reports have a very big climate impact. And it seems that you have a policy already to deal with environmental and social issues. And I just wonder, how does it work in a bank that this is still possible while you have an intention and a willingness to improve this? Where are the frictions within an institution to deal with it? And my other question is, when we talk about social and environmental impact, do we need more sector-specific aspects, for instance, for agriculture. I know that some of the banks are signing on the one on forests, on fisheries, on palm oil and other issues. Is that an approach that we have to think about in the long term, or really no?
Thank you. We have time for one last question. Okay, we have two, but quick ones. One there, one there.
My name is Beate Rabe from Eurogas. We're representing companies who are engaged in the wholesale, retail and distribution of gas in Europe. And I would like to caution against a simplified approach into brown assets and green gas assets, depending how you define them. To explain what I mean is, if you switch from coal to gas, you can reduce emissions from power generation by 50%. How do you reflect that in financing? Greenpeace Energy in Germany is using the gas network to sell renewable gas from power to gas. So using excess electricity from wind and solar to produce carbon neutral synthetic gas. If you stop investing into the natural gas network, you will stop these developments. So how do you reflect that when you are simplifying into brown assets and green assets?
Thank you. And then one last question over there. And
Thanks. My name is Kerry Evans. I work for BlackRock, a large asset manager. And my comment and question embedded in it is actually not too far off the previous question. And that is, it sometimes evades me in this discussion exactly what we are hoping to affect. And I say that very explicitly because I think there's a lot of principle embedded in this debate, and I think a lot of it is really admirable. But sometimes when you take it a step further and say, well, what do we want, say, investment professionals to do with some of these policy changes? What behavior are we trying to get them to not do any more or do more of? Is it to divest from companies that are quote brown, steer more investment towards green? On the bank side, are we trying to stop banks from lending to brown companies, encourage them to only lend to green companies? I think this is actually a really fundamental piece of the kind of sustainable finance debate that sometimes doesn't get answered. Because I think in reality, when you look at the economy overall, you've probably got two reasonably small bookends of green companies and brown companies. And the vast majority of companies in the global economy are somewhere in the middle, which are companies that are just transitioning. A lot of them don't know entirely where they're transitioning to, and I think there's a strong point to make about policy leadership in that space. But they need finance and they need investor support in order to make that transition. And I think sometimes when we talk about green and brown, or particularly kind of some of the questions around fiduciary duty, again, I mean, I don't understand sometimes if the point there is to get investment managers to stop investing in particular companies and start investing in others. And I think sometimes in the policy sense that's a really useful starting point that I'm not sure everyone's at. And so my question to the panel, I think, is really, what do you hope the market reaction to some of these policy measures that you're suggesting really is?
okay, so we have 4 questions. I'm going to try to assign one to each, although it will be a bit difficult. First of all, on how long it will take for this to become real. I don't know, maybe Peter, you'd like to talk about it.
Well, I think we have waited far too long. I agree with you. So actually the financial crisis helped a lot to make banks think about purpose. Before, I remember sitting in the Dutch Bankers Association board for many years, that when I said, well, what could our response be after the financial crisis 2008, 2009? That when the word purpose came up, they said, this is very NGO-ish. We are not in the NGO. Now banks talk about purpose. So that's a good and possibility.
They were forced to.
They were forced to, yes, but
the trust of the public was totally with them.
yeah, but I see the new generation of CEOs, board members are taking it more intrinsically and want to work more positively, see also market opportunities. So there is a change, but I think in the end, and I know this discussions for many banks, capital weights are in the end very important. So if we don't do something real concretely there, it will be a lot of I wouldn't say hot air because the intentions are right, but I think it will not change quick enough. We have to change the system, as there was a lot of resistance from the bankers when in general capital requirements went up. So people really thought they could get away with 2% leverage ratio. Now it's 4, 5, and some say it should go to 7, 8. So that is a change as well. So I think if you are persistent on those things, also an answer to you, then bankers will react. I don't think there needs to be a lot of other things than do a few of these very hard measures, and then things will change. And I feel personally, if we have reached the 20%, we have reached a tipping point where things will almost be taken care of by the market and the development itself. It's not that we have to fight for the 100%. But 1, 2% is not enough, and we have to go to 10, 20%, and then things will reach that tipping point. That's why I strongly believe in it. You have seen it in other developments too.
Then maybe, Stuart, I don't know if you'd like to respond to the more HSBC-specific question.
I was hoping you were going to time me out, but no. No, it's a very fair question, and it also relates. There's an internal answer to how do you make it real, or when does it become real. And it's a bit of a processy answer, but HSBC is a huge bank, like as any huge organisation. It's a bureaucracy, and you drive change usually starting with a very strong central push. So all of our global heads of business are now charged with working through what their business being on a more sustainable path means in terms of hard metrics, and they will all be judged against that. Their pay will be determined in part by the extent to which they successfully make this journey, and that's the way to really make change. And to tie that into your question about our current customer distribution and our client list and what it looks like, yes, it is a fact that some of our clients are involved in the fossil fuel industry. I don't think you'd find any very large bank of which that was not the case. But as part of the exercise that I'm talking about, we are having to educate all the relationship managers that we have with clients so that they can explain the journey that HSBC is on, but also engage with the clients about the sort of journey we would expect them to be on this agenda in order for us to keep having a productive relationship. So it's about, and I think it needs to be about, trying to take clients with you. And it's in all our interest generally that we transition the economy in a sort of sensible way as we can, rather than, as I say, immediately taking decisions to ditch people. And I think we do find, and I won't name any names, but we do find that even with large firms that have traditionally been in the fossil fuel business, some of them are extremely progressive in the changes they are trying to make, the attitude they're taking to renewables and looking to their own futures. So I think we do it that way. It's going to be metrics. Managers will be judged on it. But ultimately, we try and make it a journey we can go on with our clients.
And then on the last more existential question, both Dirk and Catherine will speak, maybe Catherine more on the fiduciary side of it, and Dirk, you can start.
Can I follow up on this engagement issue? Because the key is that the externalities, or most of them, are caused in the production process. So if we don't address them there, then nothing will happen. And by just divesting, somebody else will buy your shares and the thing will stay on. So I will echo Stuart. That's why my idea was about long-term investment, because then you have a stake in the company. As an investor, you engage with the company, you discuss strategy. And of course, if they don't want to listen and don't change at all, then you divest them at some point. But I think the real challenge is that investors have this discussion with voting behavior behind it. One of the big oil companies have now 2 resolutions in a row which have not been caught on, but maybe next time it will. So engagement with the companies to change their behavior to reduce the externalities. Because the externalities are not happening partly by our consumption behavior, but largely by the production choices. So I think in the end, the investors, exactly as Stuart said, whether you are a bank or an investor, you talk with your companies where you invest in, and that's why it's better to have a few large stakes so you can really talk to them rather than thousands of them. And then if they don't want to change behavior, then you have to step up your, but you have to really to make a plan together how to get to a lower carbon footprint, how to get to a living wage for your clothing industry in Bangladesh. And the goals, I think, are clear, and then you make a plan how to get there.
Oh, goodness. Well, I wanted to say a word on how long will this take. Not that I know the answers at all. Because when looking out at this, I don't know, I'm really interested in maybe in the break to have other people's perceptions on this, but there are some things that are now moving really fast and where I actually see the market really beginning to move things, which is the acceleration effect we absolutely need, and very exciting. On the other hand, you know, some of the things we need to avoid are substantial capital expenditures that lock in, you know, high carbon infrastructure and high carbon projects, and there's quite a bit of it still going on, without a doubt. So we're at this really interesting flex point where I don't know quite. There are days when I think it's really moving. We're actually really at a tipping point, a very positive one, where it's going to suddenly really start to pay to be on the right side of this. But then there are plenty of signals in the opposite direction as well. And that is actually why we really do need regulatory signals and policymaker signals that help to reinforce the positive trends. To turn to the question from BlackRock, what are we hoping for? I mean, what I think we're hoping for is that if my pension assets are with BlackRock, that and you know, millions and millions of people's are, that the asset managers at BlackRock and the fiduciary managers at BlackRock are taking a quite broad conception of what acting in my best interest looks like. Absolutely is about investing in firms that have a sustainable, smart business model and having a really constructive dialogue with management of those companies about whether they're, you know, where they are on this transition and many other issues. It may be about dialing down exposure to high carbon and dialing up exposure to pure green, but I agree that those are both in a sense marginal compared to the rest of the economy, where what we want is really engaged stewardship by institutional investors who are rewarded for doing that and who are guided by a kind of policy-led conception of fiduciary duty that encourages a broad view of what's in my best interest if my money is with you. So I don't actually think it's rocket science or that difficult. Very doable. There are fantastic portfolio managers at BlackRock who are completely doing it, I should say. So, you know, it's happening, but it just needs to be reinforced, and we need a policy signal that supports it.
Great, thank you all very much. We're now going to take a short break because we've run over time, so maybe an 8-minute break, and we'll be back at past for the closing speech. Thank you.
Okay.